Hi everybody, welcome back to Chapter 7. Page 344 of your textbook begins a discussion on accounts receivable. Accounts receivable are created when sellers recognize revenue associated with a credit sale. That could be a credit sale of services or a credit sale of products. Remember that from Chapter 6 that performance obligation is satisfied at the point of delivery and revenue and related receivables are recognized at that time. Most businesses provide credit to their customers. Accounts receivable are informal credit arrangements supported by an invoice and are normally due within 30 to 60 days after the date of sale. They are classified as a current asset because their normal collection period is part of the operating cycle of the business. Remember how we account for sales revenue. Sellers recognize an amount of revenue equal to the amount they are entitled to receive in exchange for satisfying a performance obligation. This is from Chapter 6. Sellers allocate the transaction price to various performance obligations in a contract and then recognize revenue when performance of obligations are satisfied. There are some potential complexities that were covered thoroughly in Chapter 6. One is the time value of money. Because credit sales allow a customer to get goods or services now, but pay for them in the future, you can view a credit sale as providing a loan in addition to whatever goods or services are included in the contract. However, sellers can ignore the financing component when it is not significant, which is typically a case when receivables are due in less than 1 year. Therefore, sellers usually record relatively short-term accounts receivable at the entire amount the seller expects to receive, rather than at the present value of that amount. For longer-term receivables, the financing component is more significant, and the sellers have to account for it. Another type of complexity that we covered in Chapter 6 relates to variable consideration. Contracts can include some aspect of variable consideration that must be estimated when determining the transaction price and therefore the amount of the receivable. In particular, contracts can allow sales discounts as well as sales returns and allowances. Let's discuss those complexities in turn. First, we'll talk about sales discounts. And let's distinguish a trade discount between as opposed to a sales discount. A trade discount is simply a reduction in the price from the list price. It's offered to large customers, perhaps for quantity discounts. It might be offered to contractors. Typically, a plumbing supply house will have a list price. You and I go in to buy a faucet from the plumbing supply place, and we have to pay retail or list price. But they frequently will have a trade discount available to plumbing contractors, and the plumbing contractor will pay less than the list price. Those are simply recorded as sales and accounts receivable at the price that it was sold, for which it was sold. As opposed to sales discounts, which are a reduction in the amount to be paid by a credit customer if paid within a specified period of time. And the purpose of a sales discount is an incentive to get the customer to pay quickly. Typical sales discount would be 210 net 30, meaning that a customer can take a 2% discount if they pay the bill within 10 days. Otherwise, full payment is due within 30 days. This was covered thoroughly in Accounting 301. And here's an example. The Hawthorne Manufacturing Company offers credit customers a 2% sales discount if the sales price is paid within 10 days. Any amounts not paid within 10 days are due in 30 days. These repayment terms are stated as 210 net 30. On October 5th, Hawthorne sold merchandise at a price of $20,000. The customer paid $13,720, which represents $14,000 less a 2% cash discount on October 14th within the 10-day discount period, and then paid the remaining $6,000 after the discount period expired. So they didn't get a discount on that $6,000. There are two methods to account for sales discounts. One is the gross method and one is the net method. Using the gross method, we initially record the revenue and related receivable at the full selling price and record the sales discount at the time the customer remits payment within the discount period. Using the net method, we record the revenue and related accounts receivable at the agreed upon price less the discount allowed in the credit terms offered to the customer, and adjust this amount if the customer does not take advantage of favorable credit terms. So in our example for Hawthorne, we made a sale of $20,000. Under the gross method, we're going to debit accounts receivable and credit sales revenue for $20,000. Under the net method, though, we're going to make the assumption that the amount we expect to receive is only $19,600. We are assuming that the customer will take the 2% discount. Therefore, we debit accounts receivable for the net amount, $19,600, and credit sales revenue for the net amount, $19,600. In this example, Hawthorne made two payments to us. They made, in essence, a $14,000 payment within the discount period, and the remaining $6,000 payment was made after the discount period expired. So they did not get a discount on that last payment. So how do we take those payments and account for them under the gross and net method? Remember, under the gross method, we recorded the entire sale of debit accounts receivable, credit sales revenue for $20,000. So we have to account for that discount when we receive the payment from the customer. And that's what's done here in the first part of this slide. Gross method, debit cash for $13,720. That was the amount of the check the customer sent us. Credit accounts receivable for the full $14,000 they paid, because we told them they could take a 2% discount and they don't owe us any of that $14,000 at this point. But if all we did was debit cash for $13,720 and credit accounts receivable $14,000, we would not be in balance. That $280 debit, which is 2% of $14,000, has to be debited to a contra revenue account called sales discounts. Now our journal entry is in balance. Debit cash $13,720, debit sales discounts $280, credit accounts receivable $14,000. Under the net method, remember that we've already taken into consideration the discount, 2% discount amount. We have recorded our revenue and our receivable at a 98% value. Therefore, all we need to do under the net method is debit cash for the amount of cash received and debit accounts receivable for the amount of received. Now that last $6,000 payment, they're not going to get a discount on that, because they paid after the 10-day credit period. So In this case, under the gross method, you simply debit cash and credit accounts receivable. Under the net method, we actually have to credit a revenue account for discounts forfeited. So we debit cash for the $6,000 we received. We credit accounts receivable for $5,880, and we credit discounts forfeited $120. Under both methods now, accounts receivable will equal 0, and this net sales revenue will be the same under both methods. Remember that we recorded sales revenue under the gross method of $20,000. Then we recorded a sales discount, which is a contra revenue account, of $280, which then equals net sales revenue under the gross method of $19,720. Under the net method, we recorded sales revenue at the 98% number, assuming the customer was going to take the full 2% discount. And then in the second payment, when they forfeited a $120 discount, that will add then to our revenue. And our net sales revenue is $19,720. The net sales revenue under both methods is the same. So here's a problem for you. Pause your video to consider which would be the correct answer. The question asks, which of the following is not true about recording sales discounts? Is it A, the gross method records sales discounts when payment occurs during the discount period? Remember, we're looking for what is not true. Is it B, the net method records sales discounts not taken as sales discounts are forfeited? Is it C, net sales revenue is higher under the gross method than under the net method? Or is it D, sales revenue is the same under both methods? Choose your answer. We're looking for the one that is a false statement or an untrue statement regarding sales discounts. The correct answer is C. The sales revenue is the same under both methods. So which method should a company use? Which one is correct? Sales revenue and corresponding accounts receivable should be stated at the amount of consideration the seller expects to be entitled to receive. The net method typically better reflects that amount because the discount is a savings that a prudent customer would be unwilling to forgo. Here's a little bit of math that pretty much astonished me. To save, let's say it's a sale of $100, they get a 2% discount if paid within 10 days. Otherwise, the full amount is due within 30 days. So to save $2, the customer must pay $98 within 20 days, within 10 days, which is 20 days earlier than when the full $100 would be due. Look at it this way. $2 isn't much, but when you look at it this way, investing $98 to earn $2 is a 2.04% return for the 20-day period. Convert that to an annual effective interest rate, it's 37.23% annual effective interest rate. So when they say prudent customers would not be willing to forego the discount, with this kind of a calculation, I wouldn't be willing to forego the discount either. So because revenue should be recorded at the amount expected to be received, then the net method would be more correct. That's all for this video. When we come back, we'll talk about sales returns and allowances.